Hi guys, welcome back. Today for technical analysis reading the charts, we are moving on to chapter 2. What makes the markets move? For this chapter, we will cover supply and demand with apples, applying it to the markets, main factors affecting supply and demand, positive, negative, and unexpected, a note on the markets, and finally, a sum up of the lesson. So before we begin, I just want to show you how stocks typically move. What we have here is the chart of Facebook, and you can look at how Facebook moved over a period of 1 year. So you will notice that the movement of a stock is not in a linear pattern, meaning it does not move up in a straight line, nor does it come down in a straight line. Stocks typically follow a zigzag pattern. This means when a stock moves up, it would come back down for a while before continuing the move upwards. And you can see it happening over here as well. As Facebook moved up, it came back down for a while before continuing to move up again. The same happens when a stock is moving down. As it moves down, it will move up for a while before continuing its move downwards. Now stocks move in a zigzag pattern because investors are opening new positions or selling old positions. So to get a better idea of why this happens, let's look at our next example. Supply and demand is the basic factor that drives the market. So let me give you an example using apples on how supply and demand works. So imagine you are an apple seller and that you sell apples. So you find that the demand for your apples is about 10 apples a day. Now imagine if one day scientists were to release a research article saying that, eating apples will make people live longer. Then you find that the demand for your apple shoots all the way up to 100 apples a day. And here is an example of when demand is larger than supply. Because you can only provide 10 apples, but the demand for your apples is 100. So the price of each apple that you're selling will increase. But what if, however, scientists were to release a research article saying that, eating apples, they are harmful and that you shouldn't eat apples as it will cause you to lose your hair. Suddenly you find that the demand for your apples from 10 apples a day, it drops all the way to 0 apples a day. So here is an example of when supply is larger than demand. Because you can provide 10 apples a day, however you find that nobody wants to buy your apple and that the demand for it is 0. So the price of each apple that you are selling will drop. The concept of supply and demand is also applied to the markets. When there are more sellers than buyers, or when we say there are more bears than bulls, the stock prices will fall. And we call this a bearish market. When there are more buyers than sellers, or when there are more bulls than bears, the stock prices will rise. And we call this a bullish market.